Welcome to another exciting and informative episode of the Entreprenudist Podcast, a place to hear real entrepreneurs and business owners bear it all. I'm your host, Randolph Love III, and we do have another serial entrepreneur on the episode today. But before we bring them up, I do want to remind you that this episode is brought to you by Shield Wolf Strongholds, a wealth growth and protection company when it comes to estate planning, when it comes to employee benefits, when it comes to retirement planning, when it comes to life insurance. If your plan ain't Shield Wolf, your plan ain't strong. If you are a business owner that wants you and your employees to retire higher than you would have prior, make sure you visit shieldwolfstrong.com or call or text +1 904 822 4262. Now to our guests. If you don't have a business wealth navigator, you are leaving so much wealth on the table. A navigator can take you through all of the turns you have been missing on the road to business success. The navigator does everything they can to get you from good to better in every single aspect of your business. If you are driving your business without a navigator, you are driving blind. Reach out to our business wealth navigators at enterprisesage.com to receive an honest evaluation of your business and what you could do to maximize. A founder and chief executive officer of Enterprise Sage, a serial entrepreneur, seasoned C-level executive, and business consultant, Craig brings more than 3 decades of financial services and investment management expertise. His career has been dedicated to helping business owners maximize value, protect assets, and manage complex wealth outcomes. Craig Morningstar, welcome to the Entreprenudist Podcast.
Randolph, wonderful to be here today with you and your audience. Thank you for having me on today.
Absolutely. And we are recording in the morning, so I guess that brings some value to your name. Where does a name like Morningstar come from?
Yeah, it got translated from German, 4 or 5 generations ago. Now, if you're in the financial service industry, like you are, Randolph, hey, it's a rating service that's out there.
Absolutely. Is there nothing that you know now that you wish you knew when you first started?
Oh, man. You see that stack of books behind me? I got like stacks all over the place of books. Man, just so many things in the financial service industry. As you know, it can be really complex. And then you match that up with a business. And then all the things you learn from having multiple businesses and then working with literally hundreds of business owners. What is it I wish I knew? I wish there was one place that people could go to and work with a person or a group of people that had a wide range of skill sets. But unfortunately, a lot of service providers, they have a hammer and everything looks like a nail. You can't paint a building with a hammer. You can't lay bricks with a hammer. So it is all the different knowledge silos that are really difficult to connect for entrepreneurs. Entrepreneurs got a business to run. And they don't typically have the time to figure out all the details to connect all the dots. So unfortunately, AI is not there yet because all the complexities between the personal side, the legal side, business operations, growth, sales, all those things, all those hats that the entrepreneurs need to wear. I wish somebody would have told me all those complexities, but just learned the hard way. School of hard knocks.
Okay. So sounds like what you're saying is you wish you knew how complicated it was.
Yeah, I wish I would have known because it would have had better results sooner. But each company that I've had, every opportunity I've had, it's always gotten better. So always have the mindset of what you have is good. How do you make it better? And always look for those opportunities.
What was your first company?
First company I actually took over from my brother, and that was doing exports, and then expanded that to do imports. And now exports were from the U.S. Over to the U.K. And we exported specialty products that they didn't have there in limited quantities. And then we brought back specialty products that were in the U.S. It was in China and toys and other things. That was an interesting experience because, hey, I had to figure out how to deal with currencies and then do the pricing with the currencies and with the tariffs at the time as well on the various products. So yeah, it was an interesting adventure, but I learned quick, and my brother was a good teacher.
Oh, imports and exports. So, and dealing with those tariffs. So, when all this tariff talk started, relatively recently, did that not scare you, or was it like, all right, here we go again, or what was your thoughts on it?
It was, okay, here we go again. Here's your price. Now add X amount onto it. That's your cost. Now you got to add on your profit margin. You got to add on a few other things. You figure it out. Okay, that's what you got to do. So, started doing that at the age of 16. So when the tariffs came up against, like, okay, let's bring out the old skill sets and just figure out how to do things. So,
okay. So what type of people do you work with now?
After multiple decades of having serial entrepreneurship and also corporate jobs. So I like to do what I refer to as intrapreneur. It's an entrepreneur that's inside of a company. I did that a few times. So what we do is we work with business owners to help them navigate their business wealth. What most people don't realize, if you're working for a company, right, your wealth is going to be in the 401k, your house, and other things. When you're a business owner, the bulk of your wealth is tied to your business. Mm-hmm. And unfortunately, a lot of people manage that wealth of their business by accident. They manage the business by intention, but they manage the wealth of their business by accident. They don't even know it's there. And they think, okay, well, at some time I'm going to exit. Well, what about all the wealth that you can extract along the way? So, Randolph, you're very skilled and knowledgeable in the financial services industry. I'm sure you've heard of defined benefit and cash balance plans.
Of course.
Most owners, okay, they're going to do a 401k. We're going to do a solo 401k if they're a small business owner. There are other solutions where they can take out a lot more before they ever sell that business. And then where a business has some middle management or other senior managers, using life insurance to put those golden handcuffs so those senior managers stay on for a year or two or three after the business is sold. Those little things increase the value of the business. Defined benefit, cash balance plans, and other solutions, they increase the amount of wealth that business owners can extract prior to the business sale. There are hundreds of things like that. The other thing is, can you imagine if you bought a house and from the day you bought it, you never had any idea of what it was worth? Okay, now let's take that to a business. You're building your business. You had the business 5, 10, 15, 20 years, whatever the time frame is, and you had no real idea of the value. Because there are ways to value a business for key man insurance. There's ways to value it for transactions. There's ways to value business for divorce. It's the same business at the same point in time, but there are different numbers for different reasons. It would drive people nuts. So there is an opportunity with Enterprise Sage where you can go to the website and it takes 10 minutes and 18 questions, and you'll get a value of your business within 90%. It's as simple as that. So we enable entrepreneurs to the first time have easy access to the value of their business and show them what additional value they can increase. And then we roadmap out, okay, if you do these X things, and in the particular areas of the business, it will typically increase the value. There are 18 key drivers of business value. Most people think, okay, it's the revenue and what's my EBITDA. And then a few other add back in. There are ways to increase the value of business that does not mean increasing the revenue. So having a strong management team, having written policies, procedures, having a diverse customer base, managing your accounts receivable, all of those things and many more go to increasing the value of the business. But no one ever tells an entrepreneur that. So at Business Wealth Navigators, so take time to understand the business. Here's what it's worth. Here's what it could be worth. Now let's help you navigate to optimize the value of your business before you exit, extracting what you can along the way, near the exit and after the exit. That's what business wealth navigation is all about. not just waiting until the end and sell it and see what you get and usually pay more than taxes than you should have.
Okay, so it sounds like the first step, regardless of whether somebody feels like they want to sell tomorrow, 3, 6, 10 years from now, is figuring out what the value of their business is now. Yep. How do you help people figure out the value of their business?
We have various softwares that we use. Those softwares are designed and enhanced by data scientists that have focused their professional careers on business valuations. And they've looked at hundreds of thousands of business valuations. And they've determined those key drivers. So literally by answering questions about those key drivers, you get a relatively good sense of what the business is worth. That same software also shows the gap in the value. So as an example, let's say you have a company and they have 5 clients. That's all they have. So there's a lot of concentrated risk there. If that same company had 20, 30, 40 clients or more, you would have a diversified risk. So that higher risk actually decreases the value of the business. So those 18 key drivers are used to determine the value. They're also used to determine the potential future value of that business by finding the gaps. And then we use those gaps as, let's take 1% of your EBITDA, and let's apply that 1% to unlocking the hidden value in the business and improving those areas. So here's your value, here's your gap, here's where we can narrow that gap and increase the value. It is literally a roadmap that we work with entrepreneurs to navigate on. But then we also find all kinds of opportunities, such as with cost segregation. You have business owners, they put in tenant improvements into the property, or they own the property, and most of them just take the straight line depreciation. If you accelerate that depreciation with cost segregation studies, you can improve your cash flow, and then in cash flow can go to improving your EBITDA, which can go to improving the value of the business. It is literally hundreds of simple things like this. But when you put all of these together and you have somebody working with you to navigate, literally, it's like driving blind versus driving with a GPS. You're typically going to get better results with GPS. Once in a while, the GPS is going to have some bad signals with it, but driving with the GPS is going to get you better results than literally driving blind. That's what business wealth navigation is about.
Oh, yeah. A GPS is definitely a great metaphor. I know one of the things that, I was around before GPS. I was around when you had to go to a landmark and then stop at the payphone and then say, hey, I'm here. Where else I do? Or you had to print out and then go to the next stage where you had to look it up on MapQuest and then print out the directions, right? But when the GPS first came out, at one point, you literally had to put in that you at your current location and then put in the address. Now, the GPS automatically puts in the current location, but a lot of people like to only think about the destination without the current location and not realizing that GPS works by triangulation. And until you put in where you currently at, you cannot track where you want to go. And is that the whole metaphor behind why you have that unique name, that navigator, that wealth navigator?
You hit a keyword, destination. Most entrepreneurs, when they first started the business, it's about keeping the lights on and keeping the employees and everything else and building the brand and those things. And then over time, they think about the destination, but it's really about the journey to that destination and then beyond that destination. So, Randall, since you're in the financial service industry, you know about target date funds, right? So from whatever age to the age of 65. Well, what about the next 20, 30 years you're going to live past 65? And it's about that entire journey. And people do that with their personal wealth. We help business owners do it from the time that they go into business, sometimes before they go into business, all the way through that exit and working with them to navigate all the way through that and even beyond the exit. And that's where you get into the investment component, but also the estate component, the taxes, how to minimize the estate taxes. If it's a substantial amount, they're going to leave to their heirs. All of that's part of the navigation process. And if you just work with one provider, typically it's an estate planning attorney or a CPA or financial advisor, they're going to know their piece of it, but they're not going to know all the different ways those pieces can be optimized and how they work together. And a lot of times, unfortunately, the business owner is left to figure it out for themselves and unfortunately can disadvantage themselves. So it's complex. What somebody has is good. It's good that they have something versus nothing. But how do you make it better along that entire journey of business ownership?
Oh yeah, the journey is the destination. And yeah, a lot of business owners are smart enough to understand that they need help. But as you alluded to, if you have one practitioner over here, the other practitioner over here, the other practitioner over here, your CPA over here, your insurance broker over here, your banker over here, your attorney over here, it can turn into that old school game of telephone, where you whisper in somebody's ear a sentence, and by the second person, it completely changes. And that's a fun game to figure out what the sentence changed to from the first person to the last person. But when it comes to successfully exiting your business, that might not be the best game to play.
And usually the entrepreneur unknowingly pays the price of leaving 40 to 70% of their wealth that's been built in that business on the table, and they never know it. No one's going to say, hey, or buyer's not going to say, hey, if you did these things, I'd actually pay more for it. No, the buyer sees those opportunities. So it is painful to come in usually in the last 3 to 6 months of a situation where somebody's thinking of selling, they just, for whatever reason, they need to exit, or a family has to take care of exiting the business because unfortunately the business owner died. And there is so much wealth that's left on the table because of a lack of planning. So again, Randolph, you are in the financial service industry. You know the value of planning and how planning can make a heck of a difference in the outcomes. It's the journey and the outcomes that they live in their financial house for the rest of their life. The same thing applies to business owners. But unfortunately, business owners are so busy keeping the lights on and making things grow and keeping everybody happy and getting more customers. I think of it's like they've got their nose in the tree bark. They don't realize there's a tree and the trees in the forest. You got to see all three levels, but there's so much going on. So business wealth navigation is about that journey and to help people get more wealth and that multi-generational wealth.
Oh yeah, absolutely. I know you mentioned EBITDA, tomato, earnings before interest, taxes, and amortization, and that is definitely one of the main drivers of the valuation of the business. But just like you mentioned, those golden handcuffs, that's a lot of people think when they get that letter of intent from a potential buyer that, they just hit the lottery. No, that's when the real work starts. And because a lot of people who are buying businesses don't want to buy a job. They don't want to buy something thinking that they're going to start working every day. And when you don't have those golden handcuffs in place, they think that your key employees might just leave with you before the ink is dry on the sale of the business. What are some great golden handcuffs that you could recommend to business owners to help them maintain or increase the valuation of their company?
Non-qualified comp, which is, as you know, is usually tied to life insurance. So you think of it this way. You've got a manager, you're paying the manager somewhere between $100,000 and $200,000, maybe $250,000 a year. They take care of all the day-to-day stuff that the business owner doesn't need to be involved in. And so you've got 2 or 3 of those running your business. You got employees of, whether it's 20 or 50 or 100, right? You've got that key level management. They know how to fix things. They know how to get things done. So when you get that letter of intent, if they leave, the value of your business, because you didn't protect it, is now exposed. And somebody's going to pay less for that. So where you can pay the premiums on those life insurance policies, those golden handcuffs, you typically get more back in the value of the business than it cost you in the premiums to put in there. So why not put the golden handcuffs on? I mean, they can leave, right? But they're leaving a lot of money behind. But if they stay for whatever the time frame is, 1, 2, 3 years, they're going to get a chunk of money. They're going to have an opportunity to get to know the new management company, and maybe the new management company is going to pay them more. So you, just by doing the golden handcuffs, you kept them on board. You maintain the value of the business, and for the new buyer, you've increased the value of the business, because you don't want to buy something and then have the key management team leave, because now you've got to get your own management team in. You might lose customers, and the business is going to be dysfunctional for a little while until you figure things out. That's the last thing that a buyer wants. So the golden handcuffs are wonderful. And also having a transparent conversation with the senior level managers that I'm thinking of selling in this amount of time, but put those golden handcuffs on before. Let them know where they're going to be. Because if you and I were in that position, we're working for somebody, they say, hey, I'm going to sell, or I'm thinking of selling. First thing we're thinking about is, okay, wait a minute, what's going to happen to my job? I have to go out and get another job based upon my income. It's going to take me 6 to 12 months to find a similar job with similar compensation. Maybe I'm going to have to move. There's all kinds of worries that come into those employees' heads. Make those worries go away. Have the transparent conversation. Make it financially feasible for them. Have employment contracts. Those are some of the simplest things that people can do. Increases the value of the business and protects the value of the business. That's what buyers want. They're buying an economic engine. When somebody buys a business, they're buying an economic engine. And you don't want to have surprises. Surprises usually decrease the value of the business. There's a point that you made there. When you've got a letter of intent, when a business is auctioned, would be the appropriate term. You've got multiple buyers, and you typically get more. So if you got one buyer, okay. If you got two, it's a little better. But where you go through an auction process, you've got all your due diligence taken care of. You've got everything maximized in the value. Then you take it to an auction, and you have multiple buyers. That's where you get the optimum price. But it's not just about the exit price. It's about all the value that you can stack up in the years before you sell. So, Randolph, so you take somebody who's 50, 55, 60 years of age. You got a husband and a wife team working in the business. They can put away $200,000, maybe $250,000 a year plus each through that defined benefit structure. All right, so let's use a round number, $500,000 for 5 years. It grows a little bit. You end up with $2 and $2.75, maybe $3 million. That's now in those retirement accounts. So you've got to extract it before you do the sale. And if you don't, you simply pay more taxes than you need to.
Absolutely. One of my favorite sayings is they say the best time to plant a tree was 20 years ago. But the second best time is today. And right. a lot of people might feel as if, man, it's too late for me to make these changes. But like you said, there are certain things that you can put into place. I know you mentioned the cost segregation study, and typically the way it is with property, they have that flat schedule that you're able to write these things off. I believe it's 27 and a half years. However, with that cost segregation study, what it does, and I know people have heard it a lot, but what it does is it takes every component of that building, the flooring, the gypsum board, the windows, all of these different structures that might what's the word I'm looking for? The value, that's right. It depreciates faster over time. And if you have that segregation study, instead of being limited to having that low depreciation, you can have a higher one. Can you speak more on how the cost segregation works and how it can help business owners increase that value or extract more value? Sure.
So it's not only the stuff that goes inside of the business, inside the building. It can be things like the parking lot. So you repave the parking lot, you put up new lights in the parking lot, you put up new concrete barriers in the parking lot. Those all have separate depreciation schedules instead of just a standard depreciation schedule. So when you can take that depreciation and accelerate it, it goes to improving your cash flow. Now that you're improving your cash flow, you can do things with that additional cash flow. You can put it into growth if you want to grow the revenue. You can put it into increasing the value without increasing the revenue. So it is literally newfound money. And there are firms out there that specialize in doing cost segregation. But that is one of many, many different things that a business owner can do. Employment contracts, appropriate funding of retirement plans, golden handcuffs, legal structures. Is there estate planning appropriate for now the ownership of the business? How is that ownership of the business going to transfer to the next generation? There was a client situation I was working on the last couple of weeks, and the gentleman has a business. He needed to do additional funding in it, so we talked about some different structures. And what he decided to do was he decided to extract money, appropriately so, from a rollover account that went into a 401k account, and that put in money into his company. So he used that money to buy equity in his company. Now, his company has a substantial market upside. Potential value of that company is in the $100 million plus range. So his returns, assuming that everything's works out, and he's able to get that $100 million in potential value. Well, that equity is now owned inside of his retirement plan. So he's not going to be paying capital gains on that small amount of money that he used to buy equity in his company. Mm-hmm. So that's just another tool to manage the capital gains. Oftentimes people think of taxes, I need to go to my CPA. But Randolph, you know that as an advisor, you work with clients in all kinds of different situations on their taxes that their CPA oftentimes is not aware of. You have a conversation with the client's CPA, and the two of you work it out together. But then you bring in the attorney for the estate structure or the corporate legal structure. But then you bring in a cost segregation consultant. And then you bring in a CFO, because maybe they got a bookkeeper or an accountant, but they don't have the CFO, Chief Financial Officer. And a CFO they navigate forward by looking out the front window. CPAs usually drive forward by looking out the rearview mirror, because the stuff's already been done. You really can't change it. It takes that looking forward and looking behind to optimize the tax results, to optimize the financial outcomes. There are so many different ways to improve the outcomes. It's just like when you work with a client, right? You look at all the different things they have going on and you optimize their outcome. Hey, what they have is good. How do you make it better? Same thing with business owners. It's their wealth that's in the business, and it's not about the exit. It's about everything before the exit, at the exit, and years past the exit. That's what navigation is about.
Oh, yeah. Most CPAs record history, whereas advisors help the business owner write history. And it sounds like that's what you're doing over there at your company. What's the description of the preferred person that we should introduce you to? Anybody listening?
You got a business? It's up and running. You know that you're on a journey. You'd like to know what the value is, and you'd like to know how to increase the value, and how do you extract more value along the way? Because again, it is not about the exit. If you take your wealth out at the exit, you've already made the decision years before to leave that money on the table. It's like what you said about planting the tree. And you and I both know the time value of money, right? And the impact of compounding. It is that same basic principle, extracting money out of the business appropriately and legally so as you go along years before. It's not just about the exit. Too many times, Randall, I'm sure you've seen this. You're talking to the entrepreneur, and they say, "Yeah, you know what? I'm going to die in my business." Like, no, don't say that. You don't want to do that, right? You got grandkids, you got family, you got all kinds of other things after the sale of the business, and unfortunately, Entrepreneurship can be a stressful job at times. And there are many entrepreneurs who died at their desk or died in the business. Your business is just part of the financial house that you live in for the rest of your life. So from the day that you earn $1 till the day that you're no longer on this earth, you're in your financial house. Manage that financial house of your business. That's your illiquid wealth is your business. Your liquid wealth is your investments. Manage them with the same attention, care, and professionalism, and you will get better results.
Oh yeah, so, and go ahead.
Yeah, so if you're a business owner, you're on the journey. Realize that you're on the journey. Reach out and get help from multiple different service providers. But again, when you do that, you're going to be the one left to figure out, okay, how do I connect all this stuff? And you're the one who's going to have to go through stacks of books to learn how to do it the right way. You don't have time for that. Hire a navigator.
Oh, yes. Statistically speaking, when you talk to, you have blue collar workers and you have white collar workers. When you talk to those blue collar workers, they're typically the ones that say that I'm going to die in my business, right? They seem very happy at what they do. When you talk to the white collar workers, they're typically the ones that say, oh yeah, I'm going to, they usually have a specific age at which they're going to retire. But statistically, what actually ends up happening is those blue collar workers end up retiring early. Why? Because their body breaks down. Yep. And what statistically happens is those white collar workers end up continuing past their retirement age, and it might not be the same capacity, and they might even switch to a consulting type of base, but usually they end up working longer. I said that to say this, to add on to your point, whether you think you're going to die with your shoes on or not, you definitely need to speak to somebody like you, Craig. And I know you said the description of the best person to introduce you to is, do you have a business? Is it up and running? I would actually say, but even before you start your business, you should be talking to somebody like Craig, because once again, the best time to put together your exit is before you start.
Randolph, there's two ways to exit a business. One's vertical, walking out the door. The other one's laying down, right? And they're carrying you out the door. And vertical is just so much better. It is the entrepreneur mindset is, I got to focus on all the things day to day. And unfortunately, sometimes an entrepreneur is an arsonist and the fire department at the same time. And they got to step in and micromanage or whatever else it might be. A lot of the business owners, I would say a few hundred business owners I've worked with over the decades, they didn't realize that they were the arsonists setting the fire, and they were the fire department putting out the fire that they set. So it's usually a couple of questions, and it's like, wait a minute, did I start that problem? Yes, you did. Okay, then you had to take the time to focus and fix that problem that you created. What I learned a long time ago, and I wrote a best-selling book, it's called The Rudolph Factor, co-authored it, is that the people closest to the problem, that's the frontline employees, are usually the closest ones to the solution. All you have to do is empower and enable them. You made a great comment there about the blue-collar, white-collar folks. You got the plumber. Okay, he blows out his knees, and he can't get down on his knees anymore to do the plumbing. Or you got the electrician, you know what, and he doesn't want to go up in the attic where it's 100 plus degrees, and he can't stand on the ladder for an hour working on the different things. They're forced to retire because their body simply won't take it anymore. But they can't wait till they exit as a tradesperson. You got to start years and years ahead of time and use time. Your time is not free, right? So people need to get paid for their time. But use time to your advantage as you build the wealth in your business and you extract wealth in your business. So in the world of investing, time is your friend when you have it. Time is your enemy when you don't. The time value of money and the time value of compounding. That's what makes a difference in the outcomes.
Oh, yeah, I heard something relatively recently. They say when you're healthy, you got 1 million problems. When you're not healthy, you only got one problem, right? Yeah, and to use your metaphor, just like a real fire, sometimes putting out the fire, that fire department coming out, putting out that kitchen fire causes more water damage than the fire did in itself. So you definitely, hopefully you can avoid the fire, but if you have to put out the fire, you definitely want to be very strategic with it. You shared a lot of value with us today, Craig. Is there not a question that I did not ask you that I should have?
That's an excellent one. I think the only question is what happens when people do it wrong, or they don't do it as best they could. And Brenda, you've been in the financial service industry for a while. I've been in it for a while. You and I both know the pain when someone walks in the door and they're X age, whether 60, 65, 70, whatever it is. They didn't start early enough. They didn't save enough. And you got to deliver the bad news of, okay, you either need to substantially cut your expenses or you need to go out and keep working. Because you don't have enough, there's not enough money to get to the end of the road. Yeah, that's the painful one. I've had to do that a few times. I'm sure you've had to. But that's where your audience, your listeners, your business owners, even non-business owners, God, please start early. And, it just get started doing something, because it makes a huge difference. I think I'll leave it at that one today. Yeah, do something. So you're doing something good. And then work with somebody and make it better.
Oh, man. Just get started.
Yeah.
Thank you so much, Craig Morningstar, for coming on the Entreprenudist Podcast. The only Morningstar that I know is the sun, and the sun brightens the day. I want to thank you for brightening our day here on the Entreprenudist Podcast. This has been another episode of the Entreprenudist Podcast, a place to hear real entrepreneurs and business owners bear it all. I'm your host, Randolph Love III. And if you are listening to us on audio, make sure you check out the show notes. That way you can get more information about Craig. You can also click the link to watch the video, and you can watch our handsome and immaculate ebony and ivory faces in your places. Until next time, remember, don't play with it, stay with it until you make pay with it. This is the Entreprenudist Podcast, signing off.